Today we're going to talk about Chapter 2, Introduction to Oil and Gas Accounting. You'll finally get to start looking at journal entries that we're used to looking at. First, we're going to talk about the different categories of reserves, and these are accounted for differently. Basically, proved versus unproved. So to have a proved property, it has to have reasonable certainty that there is some product from known reserves. This can be further categorized into proved developed, that can be recovered through existing wells and equipment on the property, and proved undeveloped. It can be recovered through new wells and equipment, is undrilled, or needs major expenditure for completion. We talked about proved, now it's versus unproved. Basically, if there are not any proved reserves with the property, then it is considered unproved. This is a flow chart defining each category. Again, it gives you some definition on what is proved, and then that's further split between proved developed and proved undeveloped, versus unproved, where there are not any proved reserves associated with the product. There's different well types, and these are going to be accounted for differently. If it's an unproved area, then it's going to be considered an exploratory well. So wildcat would be there's no exploration or production in the area. Delineation, drilled where engineers believe that the outer perimeter of the reservoir is why they're drilling the well, to determine what that perimeter is. And you can have an extension well. This will be drilled to test the boundaries of the known reservoir. You can have the developmental well. This is an approved area. Again, it's going to have proved reserves associated with it. For example, you may have a delineation, maybe to get additional reserves from the property. You may have a service well. This would be drilled for purpose of supporting the production. This would be also a developmental proved reserve. So for example, water injection, again, to increase the reserves. And you may have a stratigraphic test well. This will be to obtain information about the property and about the reserves, and not for production of those reserves. These could be considered exploratory or developmental. There's four basic types of costs. Your acquisition costs, which are costs incurred in acquiring the property. Your exploration costs, costs incurred in exploring the property. That's going to include your exploratory wells. You can have development costs if the reserves are proved, and production costs, which would include lifting, gathering, treating, and storage. Now, these different types of costs are going to be accounted for differently. There's two basic accounting methods. You can have the successful efforts method or the full cost method. For our purposes, it's going to always be defined which method is going to be followed, and we're going to discuss both of them in this chapter. It's really all about timing between the two different costs. Are you going to capitalize certain expenditures, or are they going to be expensed? With the full cost method, successful and unsuccessful costs are going to be capitalized. So you're going to have a larger asset base because of the larger capitalization. That's versus the successful efforts, which recognizes the direct relationship between the costs incurred and the reserves discovered. So we're going to go through the different types of costs, but you can see that full cost is going to end up with larger capitalization of assets. successful efforts could have larger losses early in the property's life because if there are not any reserves discovered, depending on the type of well, it would be expensed. Now again, the primary difference between the two methods is in the timing of the expense and when it's going to be charged against revenue. So when we have a cost incurred, it's going to be capitalized and the cost expensed as expired through abandonment, impairment, or depletion. This will be similar to when we have depreciation on other types of assets. Or is it going to be expensed? It would be treated as a period expense charged against revenue in the current period. So we will see it on our income statement that year. Successful efforts, again, the direct relationship between cost incurred and reserves discovered. So if we have reserves associated with that expenditure, which it would be associated with that asset, or does it go straight to the income statement? So only exploratory drilling costs that are successful are going to be capitalized under the successful efforts method. If it's an exploratory drilling cost and it's unsuccessful, then it would be expensed and go to our income statement that period. And again, exploratory well means there are not any proved reserves associated with it. You can also have geological and geophysical costs that are going to be expensed. So as we look at our examples, we will see that these are some large dollar numbers. They're going to have a large impact on our income statement. So to compare the two methods, successful efforts versus full cost. So you have your acquisition costs. Remember, these are to acquire the property. They're going to be capitalized under both methods. Geological, geophysical costs. For successful efforts, they would be expensed. For full cost, they would be capitalized. If we drill an exploratory well, based on the results using successful efforts, will determine if it's going to be expensed or capitalized. So if we drill an exploratory well and it's dry, meaning it's unsuccessful, there are not economically feasible reserves associated with it, it's going to be expensed. If it is successful, there are some reserves that are economically feasible to extract and to produce. They would be capitalized. Exploratory wells under full cost are going to be capitalized under both scenarios. If we drill a developmental well, it has proved reserves associated with it, it's going to be capitalized under both methods. Note that a developmental well that is dry would also be capitalized. So the results of a developmental well are not significant. What is significant for the different accounting treatments is if it's exploratory or developmental. And our production costs. So these would be costs associated with the actual production of the reserves. They're going to be matched with the income and going to be expensed in both methods. So just to recap, I'm going to skip this slide because the next one has the actual numbers or actual answers to it. You could use this to maybe test yourself. Geological and geophysical costs, expensed under successful efforts, capitalized under full cost. Acquisition costs, capitalized under both methods. Exploratory dry holes, expensed under successful efforts, capitalized under full cost. If we have exploratory well that's successful, would be capitalized under both methods. Development cost or developmental well the costs and expenditures associated with it would be capitalized under both methods. Production costs, again, cost to actually produce the product would be matched, so it would be expensed under both methods. And DD&A expense, that's depreciation, depletion, and amortization, it will be expensed under both methods. But as we will see in some examples, the DD&A expense amount will be different. It will be significantly higher under full cost because we have capitalized more of our assets. So if you kind of look at the table, you can see under full cost, all of the drilling and acquisition and development costs are going to be capitalized. What will be expensed are production costs, which are going to be the period costs associated with producing that revenue, and the DD&A expense. Under successful efforts, geological and geophysical costs are going to be expensed, and if we drill an exploratory well that is dry, it will be also expensed. Now here's a note about SFAS number 69, disclosures about oil and gas producing activities. If you have a publicly traded company with significant oil and, that should be gas, producing activities, you're going to have to disclose certain information, such as what your quantities of proved reserves are, capitalized costs, results of operations, future net cash flows from your proved oil and gas reserve quantities. For public and non-public companies, you're going to have to disclose the accounting method that you've chosen, successful efforts or full cost, and the manner of disposing of those capitalized costs. When I was in public accounting and we were auditing oil and gas companies, it seemed like we were always waiting on the last bit of information at the end of the audit, and that would be the reserve report. That would be from an outside party, such as some engineers or an outside firm, and it would give you the amount of reserves that were considered economically feasible. So this would be, again, we're talking about an asset. As the oil and gas prices fluctuate between years, between periods, that can become significantly different. So for example, if the oil and gas prices are down, you're comparing that to the cost to extract or produce, develop those wells, you may have less reserves than if the oil and gas prices are high. So that information can become very significant to an oil and gas company's financial statements. Now we're going to start looking at some actual journal entries. What I've done is I've taken some examples out of the book, and I know you can just read them when you read the chapter, but I wanted to kind of walk through some of the more significant journal entries and examples so we can kind of discuss them as we go. This example is on page 53 in your book. So again, it's just an overview of some of the entries with successful efforts. So on January 1st, Tyler Company spends $900,000 on G&G activities to locate and explore an oil prospect. This is an exploration activity that cannot directly find oil or gas and so cannot be termed successful. Only by drilling a well can oil or gas normally be found. We're using successful efforts, so as we discussed, this would be expensed. So we would debit G&G expense and we would credit cash. On January 15th, Tyler Company acquires a 100-acre lease, paying a $500 per acre bonus, which is an acquisition cost. Acquisition costs, as we discussed, are going to be capitalized. So we're going to debit unproved property, and it would be just the number of acres times the price per acre, and we would credit cash. On February 20th, Tyler Company drills a dry exploratory well at a cost of $700,000. Again, with successful efforts, exploratory well that's dry would be expensed. So we would debit dry hole expense and we would credit cash. On March 29th, Tyler Company drills a successful exploratory well at a cost of $825,000. Successful efforts, exploratory well that's successful is going to be capitalized. So we would debit wells and equipment and we would credit cash. In addition, because the well was considered successful, we can reclassify our acquisition costs. So we would take the $50,000, we would debit proved property, and we're going to credit unproved property. On April 10th, Tyler Company spends $850,000 on production facilities such as flow lines. This cost is incurred in preparing proved reserves for production, therefore is a developmental cost. With successful efforts, developmental costs are capitalized. So we would debit wells and equipment and credit cash. On June 3rd, Tyler Company incurs $50,000 in production costs. As we discussed, production costs associated with revenue, so we would expense them to match them with our revenue. So we're going to debit production expense and credit cash. Now we're going to go through the same transactions using the full cost method. So again, highlighting the differences. On January 1st, Tyler Company spends $900,000 on G&G activities to locate and explore an oil prospect. This is an exploration cost, but under full cost, it's going to be capitalized. So we would debit G&G costs and credit cash. On January 15th, Tyler Company acquires a 100-acre lease, paying a $500 per acre bonus, which is an acquisition cost. Again, acquisition costs are capitalized under full cost, so we would debit unproved property and we would credit cash. On February 20th, Tyler Company drills a dry exploratory well at a cost of $700,000. Under full cost, it's still going to be capitalized. So we would debit exploratory dry hole and credit cash. On March 29th, Tyler Company drills a successful exploratory well at a cost of $825,000. Exploratory wells that are successful would be capitalized. So we're going to debit wells and equipment and credit cash. And as we did with the successful efforts method, we need to reclassify our acquisition costs of $50,000. So we would debit proved property and we would credit unproved property. On April 10th, Tyler Company spends $850,000 on production facilities such as flow lines. This is a developmental cost. It's going to be capitalized. We're going to debit wells and equipment and we're going to credit cash. On June 3rd, Tyler Company incurs $50,000 in production costs. Under both methods, successful efforts and full cost, production costs are going to be expensed. So we're going to debit production expense and credit cash. Now I want to work through one more problem from the book dealing with our financial statements to highlight the effects of the different methods. This one you can find on page 71. So given the following costs for lease A, all incurred during 2018, prepare income statements and unclassified partial balance sheets for a successful efforts company and a full cost company. So you can see we have our listing of expenditures: acquisition costs, G&G costs, exploratory dry wells, successful exploratory wells, holes, developmental wells that are dry, developmental wells that are successful, cost of production facilities, production costs, our DD&A amounts, and you can see they're different between the two methods. As we discussed, it would be higher with full cost because you have a higher asset base. You have accumulated DD&A and the revenue from the sale of your oil. So one strategy to be able to work this problem would be to first note the accounting method for each expenditure. So I've done that here. We have a column for successful efforts and a column for the full cost. So acquisition costs, of course, are going to be capitalized under both methods. G&G expenditures, they're going to be expensed under successful efforts, capitalized under full cost. Our exploratory wells, if it's dry, it's expensed for successful efforts and capitalized under full cost. If it's successful, it's capitalized under both methods. Our developmental wells are going to be capitalized under both methods for both dry and successful wells. Production facilities are going to be capitalized. Our production costs are going to be expensed under both methods, and our DD&A is going to be expensed. So first we're going to work on the income statement. So of course our revenue is going to be the same in both methods. That's the amount that we're receiving from our customers. Then we're going to work on our expenses. So you can see successful efforts is going to have higher expenses. G&G expense, dry hole expense, production expense, and the amount of DD&A, giving us a net loss of $1,470,000. Versus if we have the full cost, we're only going to expense production expenses and DD&A, and we would end up with income of $40,000. On our balance sheet, again, just listing and thinking about the differences between the two methods. For successful efforts, we're going to have our acquisition costs capitalized, our successful exploratory wells, our developmental wells, both dry and successful, production facilities, accumulated DD&A, giving us net oil and gas assets of $1,155,000, versus our full cost, where we have more items and expenditures that are capitalized. So we end up with a higher asset base under full cost, and of course this is going to lead to higher DD&A expense in the future. So this concludes Chapter 2.